Hey guys, Eric here, Mr. Fired Up Wealth, and I want to make a quick video today to talk about the different types of stocks and when they might be useful. We had a discussion in the Fired Up Wealth group on Facebook, and of course it always gets a little heated because you've got different types of investors, you've got different risk tolerances and ages and things like that. So when you think of Fired Up Wealth is financial independence, retire early with dividends. So your goal is to retire young, say in your 30s or 40s, most likely in your 40s, because you're trying to build up enough capital so that you can live off the dividend income and basically never sell any of the stocks either. So no 4% rule. So let's stay on track with the topic though. So different types of stocks. The first type of stock when you're young, growth stock. So you're looking for stocks that are going to accumulate, rapidly, like Fastly. So Fastly would be a high flyer growth stock. There's a lot of risk. There's a lot of reward. Those are the type of risks you want to take when you're younger, in your 20s, maybe even in your 30s, depending on your time horizon. Now, depending on your risk tolerance, you might not agree, and you might be a dividend type investor, and that's fine. If you are going to do dividends either as all of your portfolio or part of your portfolio, when you're young, you still want either DGI or DGIF. Now, DGIF is just dividend growth investing for FIRE. That just means total growth. So you're trying to find companies like Microsoft, like NVIDIA, like Lam Research, like Apple, that have growth both in the share price appreciation, but also in the dividends. So the dividends are going to keep increasing and pay more each year. Now, the one that's not talked about a lot, because most people aren't at the retirement phase, is the income bucket. Now, when you think of an income stock, a perfect income stock for someone like me who's in technology is IBM. And it's always a very, very heated topic. Why would you buy IBM? It's trash. The shares are going to depreciate, blah, blah, blah. So with IBM, that's actually a turnaround story, but they've been paying dividends since 1916. So 1916, they've never missed a dividend payment. So think about that for a second. They're paying a 5.5% yield. It's a safe company. It's a safe dividend. Their payout ratio is around 50%. And they've got some catalysts with cloud and with the Red Hat acquisition, a new CEO. Those are the type of opportunities that I look for when I'm trying to retire in a couple years and live off dividends, because I understand the company. It's paying a fantastic yield that I can't get from bonds. I can't get from really anywhere else, and has one of the safest dividend scores that I can think of. Cisco is another one that would be good, but that dividend's quite a bit less than IBM. So when you think of dividend stocks, income type stocks, they're going to be plays that you're trying to rely on the income and you're not as concerned about the appreciation of stock price. Obviously, you never want to buy something that has a 20% yield and the stock's going to lose 75% of its value or something like that. That's not the goal of an income stock. IBM is a perfect fit. I can't think of a better one where if I can get 2 to 3% increase on the stock price and collect a 5.5% yield, and that yield is safe, that's all I'm trying to get out of a stock like IBM. So those are the different types of buckets, guys. You've got growth, you've got DGI, and there's also a DGIF in there. It's kind of a pseudo bucket. And then you've got income stocks. Now, there's other things that you can do, like you can do gold, you can do bonds, you can do rental properties, all those different things for retirement. But I wanted to focus on those 3 types of stocks. Hope this video helps. Have a great rest of your day. Take care.